Yo, it's your boy, Tyke Investing, back with another YouTube video. And I got a really special one for y'all today. Today, I'm going to be giving you guys a complete checklist, right, for ICT trading, right? You can use this checklist literally for any trade that you're about to enter based on the model that I teach in this particular YouTube channel, right? So it's called the ICT 2022 model. Now, before I give you this checklist, let's talk about the ICT 2022 model for a second. And before we even talk about the ICT 2022 model, if you're excited to even hear about this, you already know about it, but you want to get better at it, or you know about it, but like you never considered trading it, and you're wondering, oh, okay, what is this guy going to say, and why is this the best model or the easiest model, really, rather, to trade in the entirety of the ICT realm? Press that like button. Press it first, because you're a good person, and I believe in you, and you can press that like button. That'll be great. Press that subscribe button too, and get that notification bell. I do daily reviews of NQ, yes, to help you guys get developing a bias for the next day, and also understand what happened today. And three, I got a free Discord below. Just go check it out. You don't have to wait until my daily reviews to understand what's going to happen in the market next. I talk about this live in my Discord. So go ahead, sign up for that. But let's go. It's in the description, by the way. Let's go over this checklist. Now, before we go to the checklist, actually, let's teach what the ICT 22 model is, just for those who don't know what that is. Okay? If you don't know what it is, pay attention closely. If you do know what this is, you can skip this part. Now, ICT 22 model. High, low, lower low, then this low right here. Break of market structure, right? Because we're going above this high. We purged liquidity. We've not gone above this high. That's a break of market structure. There must be a fair value gap present. What does this show? Displacement. That price is ready to go. What is a fair value gap? Fair value gap is a gap in between two candles, right? Where it's just the body. So this low to this high right here, just body right here. That's a gap. Typically, price will return back to that because that's what you call an inefficiency. Look at this one over here, right? Gap, two candles right here, big gap right there. This high, this low. Price just dips back into that gap and then continues higher, right? That is a fair value gap. Shows displacement. That price is ready to move somewhere, right? It's kind of like when you're, I see describes it when you're painting and you forget to roll over the paint twice because you're in a hurry somewhere, right? It shows displacement. Price is ready to go somewhere, right? It needs to comes back. You need to roll over that paint and then you need to keep going, okay? So that's the 22 model, and then you go from there. We can either return back to this fair value gap or we can keep it open, right? So typically on the left, you'll see, maybe a series of higher, lower lows and lower highs, right? Market structure right here is bearish until we purge liquidity right here and then break that bearish market structure and then continue higher. Or you can see a continuation where price is going up and down, up and down, up and down. Now, let's say this has been happening for a while. You need a short-term purge of liquidity, which is what we call a continuation purge, basically injecting some liquidity into the market so that we can have some power to keep going higher, right? Taking out some short-term orders. People who are trailing their stop losses, just quickly stop that out and continue going higher, right? Sometimes that's why you want to keep your stop loss maybe around here or wherever, break even from where you first entered. Because sometimes when you have these short-term retracements, you can get a short-term purge of that and then continue higher, right? So that is the 22 model. We'll be going over that in effect, but I haven't even gone over the checklist yet. So why is this model so important? First of all, it's very easy to look at, right? You can see it. Secondly, ICT said it himself. If he was going to teach his daughter any model, and let's assume that she just, is not willing to go through all the other hundreds of hours of his videos, but something that he wants her to study that is just very obvious to see in the chart, happens at certain key times of the day, right? This is your checklist. Sorry, this is the model that ICT would teach his daughter. It's that simple, right? And it happens multiple times a day. I literally show you every single time I do a daily review. It happens multiple times a day. And we'll go over some examples today. But let's go over the checklist, right? So this is your perfect ICT 22 model checklist. And you can also apply this checklist to pretty much any other model you want to trade. But for you to execute on a trade, you need to see these things. Okay, very simple. Number one, you need to have a bias. Okay, I always talk about this on my page because here's the thing: price goes up and down, up and down, up and down. But typically, price is drawing somewhere. That's what we call a draw on liquidity. So why is this so important? Especially in volatile markets, right? In this election year, this is one of the times where having a bias is some of the most important, like, it's the most critical, right? A lot of, back in the days where price was just going straight up or it's just going straight down, it's just easy to catch a short, easy to catch a long. Now price is, gyrating, right? Like even look at all this week, right? Like this has just been up and down, up and down, up and down. We don't have any direction. Last week we were just going up, so it's pretty easy to catch alongs. We've just been going up and down here, right? Past week. So it's important that you understand what the hell you're doing. Like, where is price actually going to go, right? Intrasession, intraday, right? So you need to develop a bias. If you do not have an inkling that price is more probable to go somewhere than it currently is right now, right? If you don't have an inkling of where price is about to go, where is it likely to draw to, then you should not be trading. Tape, read, watch, and then at the end of the day, screenshot and say, okay, price went here and here and here, and this is why. There was a liquidity pool here. There was a fair value gap over here, right? And once you master that, I'm telling you, trading will become like bread and butter. It'll become easy because you could just see things before they happen. You will be so much more confident, right? Multiple 22 models form in a single day. Multiple IFVGs form in a single day. Multiple turtle soups. Multiple order blocks. Which ones are the right ones to take? Usually the best ones to take are the ones that happen when you have an actual bias. Now, how do you determine this bias, right, in this checklist? So your bias, this is the first thing in the checklist. You need to have a bias. Now, what could be informing your bias? Time of day, right? So, for example, time of day is one of the most critical things that can help inform your bias, right? If it's about 11:30 onwards, you know that if we've been, trending in a certain direction, it's likely that we get a break of market structure to take out some of those orders from the daily order flow, right? If it's lunchtime, we're probably just going to consolidate, right? If we're in an upwards day, right, in the PM session, we're probably just going to take out the lunch low and then continue higher, right? Or return into a particular PD array that was in the lunch session and then continue higher, right? If it's AM session, we're probably going to have a Judas swing around 9:30 open, right? So you know that price is likely to go in the opposite direction of where you want it to go. And then after the 9:30 open, if we hit a key PD array, we can reverse and continue going higher, right? And so time of day will help you to understand what your bias is likely to be, right? If it's 10 to 11 a.m., we're likely to have a silver bullet. We're going to be going, towards the target of the day, typically. And we're going to retrace to a certain fair value gap, right? So you have a bias, right? Time of day can help you understand that. One. Also macros, right? So macros typically, like, time of day will also inform macros, or at the first 10 minutes or the last 10 minutes of an hour, right? So that 20-minute interval. So let's say like 10:50 to 11:10, 9:50 to 10:10, right? 1:50 to 2:10. A lot of those times we're forming the new hourly candle, and you see price has, in the hourly candle, you typically have a wick down and then you see it rising for the rest of the candle, right? Because that is the macro in the beginning and the last couple of minutes of the hour, where price is typically creating, a lot of times that's when you see a lot of 22 models, right? Where price is doing a short-term purge liquidity and then heading for, the most obvious draw on liquidity after that point in time. So time of day is really important. Liquidity pools, right? So equal highs, equal lows. If you see that somewhere, right, price is likely to take that out, right? Relative equal highs, relative equal lows, where orders are paired. That is a really great place for determining your bias, where price is likely to go. Especially if one side of the market, let's say we've been gyrating and we've taken out all the highs relatively, relevant highs, and then there's just a bunch of lows that have not been taken out. Your bias should be only taking shorts, right, for the rest of that session, unless we're like super bullish and we had SMT, for example, on a higher time frame. There's like a higher time frame, fair value gap, right? That's just like it needs to get traded to. Let's say, for example, we're in such a premium and, we've been going up all day, and then, the 1 hour has a fair value gap below that can get easily traced to, and you see a break of market structure on a lower time frame towards that higher time frame fair value gap. We're probably going to go fill that, right? That happened today on the 1 hour. Session highs and lows. A lot of times, London highs and London lows will get taken out, as well as Asian highs and Asian lows in the AM session, right? If not in the AM session, it will typically get taken out in the PM session, right? Both sides of those ranges will typically get taken out throughout the day. So those can be easy places for you to target, right? Even AM session highs and lows, depending on the daily profile. So determining your bias, right? Also, you can see higher time frame SMT, right? Like sometimes if you get like an SMT on a 1 hour that's bullish, you'll know that for the rest of the day, we're probably going to be going higher. Or if you have a 4 hour SMT, if you get a daily SMT, we're probably going to continue higher, right? So determining your bias, that's the number one thing in this checklist. And if you don't have this, that's why I said it first. If you don't have this, please do not trade that day. Just watch. And until you get good at determining your bias, you really shouldn't even be trading a live account. If you have no idea where price is going in the day and you just see a bunch of models you want to trade, you shouldn't be trading, right? Or trade with a mentor like myself. And you can go in the Discord and you can, go check out what I'm doing every day. I talk about bias and where I like price to go. Usually about 90% right about where price is going to go. So you should go ahead and check that out. Also, if you like what you're hearing so far, press that like button. Don't forget to do that. I believe in you. You can press it like right now. And then also subscribe. Press that subscription and then, press the notification bell. Now, here's the second thing. Now, this is where we talk about, once you have a model, we're going to be talking about the 22 model checklist. All right. So what do you need to see? You need to see a short-term purge on liquidity. Okay. And then you need to see a break of market structure. All right. And then you need to see a fair value gap. So we've gone over all three of those things, right? Once you have a bias, and once you see these, okay, that is the 22 model formation, right? So let's actually make sure this is an obvious 22 model. You don't want something that is hard to see. You want to see a very obvious 22 model. And these things are blatantly staring you in the face, right? These three things right here, okay? And then you want to also see a PD array reaction. So a reaction off a PD array. Let's actually put reaction off a PD array. Or SMT. And the reason why I say that, because yes, you want to have a bias in terms of where price is going to draw to with the draw on liquidity. Yes, you want to see an obvious 22 model. This can get further exacerbated, right, by if you see a reaction from somewhere, right? Like let's say 4 hour for value gap or a daily for value gap, right? Or you see us reacting from an NWOG or an NDOG, right? Or we're getting reacting off an ORG, reacting off, just any key higher time frame PD array or maybe key PD array in general. Which could be a reversal, could be a continuation move. But you need to also have a reason for why price is leaving the area that it's in. The reason why I say that also is because a lot of times that will help you determine is price finished heading towards where it wants to go, right? So, this is hard to kind of talk about in general, but let's say, for example, price is trending all day higher. You don't want to pick a top, right? Until it's very obvious to you that price is breaking market structure to the down low. How could you know that? So for example, if we're rising all day, sometimes we can just go hit we're rising until we get to the last level that we're trying to get to, which could be like a 4 hour for value gap, or you're taking out a session high, right? And price needs to have a reason to reverse. Otherwise, it can keep going higher. So sometimes you can see us getting to a 4 hour for value gap, and then we break market structure going lower again, right? But until we get to that 4 hour for value gap, we're probably not going to reverse. We're just going to keep going higher, right? Unless we're in like a seek and destroy profile. But if we're like on a trending day, you'll see price heading higher until it hits its final target, which could be some buy side liquidity or some sell side liquidity, right? Or it could be that 4 hour for value gap, a daily for value gap. Price is not going to reverse. Another reason why sometimes, and the only reason why you wouldn't need a PD array to look at before it reverses, even if it takes out a short term, even if it takes out that sell side liquidity, sometimes it's not going to reverse until it hits a PD array per se. Like there needs to be like a 1 hour for value gap below it, or like a 4 hour for value gap below or above that sell side liquidity or buy side liquidity. If there's no PD array, the only reason why you should expect it to reverse at that point and not continue higher until it gets to a PD array above that sell side liquidity or below that, above that buy side liquidity or below that sell side liquidity is if there's SMT with like ES, for example, if you're trading NQ or vice versa, right? Sometimes you'll see that ES did not take out its high, but NQ did, and then it starts breaking market structure lower, that is likely that it's going to reverse. So there's a reason for it to reverse as well, right? Not just understanding your bias, but also understanding like why, like, are we reacting from somewhere, or is there a reason for us to leave the current place that we're at as well? So this is a full checklist. Now let's go into a couple of examples, right? There's a really good one on ES today. And let's go over that example. So this is ES, and let's check if this pans out with our checklist. So the first thing is a bias. Now look at where we're at. We're all the way higher here on this premium. We've gone to a premium, right? Let's look at the 15-minute. I'm teaching you guys how to develop bias here. We've taken out this high right here, right? I believe we have a 1 hour SIBI over here. So I'm just going to remove that for now because we've already reacted from that. This is the high I'm talking about right here. We have a 15-minute fair value gap. Right there. 15-minute SIBI. We're at a deep premium. We've taken out this high, and this high has taken out all of these highs over here, right? So it'll be a little hard for us to take out this high because we've already taken out this high. This is a rejection block. So I'm not thinking that it's very easy for us to just continue to go up higher, especially on a day where we're just gyrating back and forth, right? You can see us getting to premiums in the range. Now that we're seeing we're gyrating back and forth, my bias is that now that we've taken out this liquidity, we're probably going to take out this liquidity over here. And let's make that a little bit clearer. Right? So imagine at this point, you see that there's relatively equal lows here. Like I said, developing your bias, right? Relatively equal lows here and here. We've already taken out all of the liquidity above here and above here. So that's your bias. Your bias is now that, hey, we have a lot of liquidity below here. We should probably revisit that. How would I know that this bias is to do that? Because sometimes you can leave this here and just continue higher. Why did I not want price to go higher? Well, because of the market context that we're in. This is why I'm also saying it's important to understand your bias. What are the market contexts we're in? We've already taken out all-time highs, right? We've taken out all-time highs. We're in such a premium. It's going to be hard for price to continue to go higher unless we have a pretty deep retracement, like at least at 50% of this range, and then we can continue higher. So what are we doing right now? We're just consolidating. After moving so much last week, we're consolidating. So what does that mean? Price goes to a premium, comes back down to a discount. Goes to a premium, come back down to a discount. Goes to a premium, come back down to a discount. So my bias is now bearish. Okay? Hopefully that makes sense. So that's your bias. Number two, we're reacting from a PD array, right? We have this 15-minute SIBI right here, right? That we're reacting from. Purge liquidity, and we have this draw and bias below. So two things of our checklist have now, out of the three, have now been there. Now, what is the next thing that you need to do? Look for your entry, which is the 22 model checklist that I talked about before. Okay? So there's no clear 22 model that's formed yet, except for maybe right here, right? So actually, this is a pretty good one. CPI happened. We went higher. We took out that high over there, came to this 15-minute SIBI. We now inverted this 1 minute fair value gap. That's technically an inversion fair value gap. Didn't take that because I don't trade that on this particular channel. High, low, higher high, right? So that is that. Let's go back to that checklist and just grab it. All right. Let's go to that checklist, bring it over here. So we have our bias, one, and we have that reaction off of PD array. All we need now is these three things in the obvious 22 model to form. Short-term purge on liquidity. In essence, this high taken out by this high. That's a short-term purge on liquidity. Even further exacerbated by an external range liquidity that was taken out over here. We're in a deep premium as well. So we're going to return back to a equilibrium. That's also informing your bias, number one. Break of market structure. We break below this low, right? Because remember I said making a series of higher highs right here. market structure gets broken here. And there's a series of fair value gaps over here as well, right? So we get a fair value gap, break a market structure, short-term purge of liquidity, reacting from a PD array, and we have our bias already established, right? All these equal those over here. Now, that is a very nice 22 model. Okay, you can set your entry into the first fair value gap at the low of that fair value gap. Maybe even make it below 1 tick, because sometimes it just touches the low of the fair value gap. Where's your stop loss? Your stop loss can be above the high of the 22 model, or if you're more experienced and you have the guts, above 3 PD arrays. So we have this breaker over here. We have these fair value gaps, and we have this 1 minute inversion fair value gap. So I would actually place my stop above this 1 minute inversion fair value gap. Plus we have this volume imbalance, very small one right here. Very small volume imbalance right there. So I keep my stop loss right there. And I aim for a 1 to 3. Now, why do I aim for 1 to 3? I did a really good series on that. Go check out my How to Trade ICT 22 model playlist and general ICT trading concepts. So you can aim for a 1 to 3 here, which is nice because we haven't even we could get that easily without even attacking all these relative equal lows, which we eventually do. Okay, so we get our entry right there. We start trading. Very nice. Now, we're going to hit our take profit, but I want to show you guys something else as this is forming. As long as your bias is still there, which is, for example, all these lows getting taken out, as long as your bias is still there, you can take multiple 22 models at once, right? So this is the first one that's shown up. Once you get to halfway, take off half your trade, set your stop to break even. Continue, because what do we have? We have the 930 open right here, where price could have spiked and hit our break even or even stopped us out. So you want to just be at break even to be safe. We keep going. Right. Okay. What do we have here? It doesn't come to our break even yet. So let's see this one right here. What do we have? 1, 2, 3. Short-term purge of liquidity. Break of market structure below this low. Fair value gap. So what can we do? We can enter another 22 model. Where would my entry be? Entry can be, because we closed so aggressively below this low, I'd probably keep my stop there below the low. Sorry, I would probably keep my entry right here at that low, because sometimes you can see these fair value gaps stay open, especially if we're in a hurry lower, right? And we're about to enter a macro, so price can start accelerating. So we may not get our fill back into that fair value gap. Just because the fair value gap is there doesn't mean we always need to return back to it. In fact, I would like this to see stated as a breakaway gap, because we have this wick right here that could keep price from coming back up there, right? Let me show you that wick. Right, you have a fair value gap, you have this breaker, you have this bearish order block, plus you have this fair value gap right here. You have this wick. That's 3 PD arrays. We keep our stop above this high right here. We aim for a 1 to 3 as well. We get tagged in on this wick back here. And you keep going lower, right? All right. So we did return back to that fair value gap. That's okay. We return back to it again. And we spike lower. So I wouldn't have set my stop to break even yet, because we haven't even gotten halfway with our trade, right? So you just have to take that heat for a little bit. But if you have a bias, this is also the important reason why you have a bias, because you also won't be scared, right? Like, I know I want price to come back lower here. So I'm not afraid if price continues to gyrate, right? We're just coming back to fill this fair value gap here. That's acceptable. You see, we don't even close. Look at that. We don't even close in the upper half of it, right? We close in the lower half of it. We wick and fill it completely, but then we immediately reject the wick, right? That means I'm still on side. So this is your second entry right now if you're trying to pyramid. Your bias is still there, okay? There's no PD array right here, but we still have our bias, and we're reacting for this 15-minute city. That's starting the MMSM, so we still had a PD array reaction, so we're still good to go. Price continues lower. But look at this again. What is this? This is now a third 22 model. This is why I say that this happens so many times a day. High right here. Gets taken out by that high. Short-term purchase liquidity. Break of market structure with this low right here. Fair value gap present. Now, why didn't we return to this fair value gap? Because of this 1 minute inversion fair value gap right here. So in order to get in, lowest hanging fruit entry would be right here at the low of this inversion fair value gap. Minus 1 tick. Because sometimes you're not going to get that entry. Where's your stop? You have this breaker right here. Fair value gap, inversion. This is a BPR plus this inversion fair value gap. You have this volume imbalance up here. So I'd probably set my stop loss somewhere around here. Just in case we retract up to that inversion fair value gap. And you can also aim for another 1 to 3. So now you have 3 22 models. Just in case you didn't get this first one, you didn't get the second one. There's a third one. Price was very forgiving today. And you see price starts going away. Take out half of our trade here. You can see that our first trade had already been hit take profit. This one is now at half. This one's also at half. You set both to break even. Remember, our bias is to go lower. And price smashes right through it. Okay? So this has been a pretty good example. If you want to see more 22 models and you want to test this checklist, right? Check out my daily NQ review series, right? If you like what you heard so far, press that like button, subscribe, and comment below. And then also check out my free Discord where I talk about these things live. And then also, if you want to see more examples of this 22 model in action, make sure that you go and check out my daily NQ review series. It's one of my playlists, right, where I do an ICT daily log showcasing these 22 models happening every single day, right? But hopefully this has been helpful. Hopefully you guys can adopt this checklist. And let me know if you want to learn anything else. See you guys next time.